So if you're still here, still holding on in the crypto world, you're probably feeling it, right? That fatigue. The market just chopping sideways. Those little sparks of hope that just fizzle out. It is absolutely exhausting. But what if I told you the key to the next monster bull run has nothing to do with crypto itself, that it has everything to do with one single incredibly powerful force on the outside? Well, that's exactly what we're breaking down today. Let's get into it.
Look, we gotta just get this out on the table. It's the question on everyone's mind, even if they're afraid to say it out loud. After all this pain, all this incredible boredom in the market, is the magic gone? Is this it for crypto? You know, it's a totally fair question, and it's pretty easy to feel that way right now.
And that feeling, it actually has a name. Crypto analyst Scott Melker calls it time-based capitulation and depression. And man, this quote just hits different. Because it's not about a big, scary, sudden crash. No, it's about the slow, soul-crushing grind of just waiting. Waiting for a recovery that never seems to come. It's a psychological war, and it wears you down.
But here's the thing. This exhaustion, this feeling of depression, it's not just in our heads. It's a direct result of a catastrophic financial event that quietly ripped the absolute heart out of this market.
Now, just look at this number for a second. $19 billion. That's how much money was liquidated from traders using leverage on a single day, October 10th. To put that into perspective for you, the whole FTX collapse, which felt like the end of the world, that was about a 1/12 of this. This event was a silent tsunami that nobody talks about.
And we're not just talking about faceless Wall Street firms here. Behind that insane $19 billion number are 1.1 million individual trading accounts. People like you and me, completely wiped out. The retail army, the people who bring the energy and fuel the altcoin seasons, they were basically vaporized in one day.
Okay, so the players are gone, the market is dead quiet, and the mood is just awful. But here's the part that is driving long-term investors completely and utterly insane. It's this great disconnect between what's happening in the real world and what the price is doing.
And this slide just lays out the paradox perfectly. On one side, you have this parade of unbelievable wins, right? ETF approvals, massive financial institutions building crypto services, governments actually creating clear rules. I mean, these are headlines we would have killed for a few years ago. And then you look at the other side, and you see nothing, just a flatlining price chart that acts like none of that good news ever happened.
So what gives? Why the disconnect? Well, Scott Melker uses what I think is the perfect analogy. He says to think of all this work by JP Morgan, Vanguard, and all these huge firms as them laying down the financial plumbing. The pipes are brand new, they are massive, and they are ready to handle a ridiculous flow of capital. There's just one problem. The water hasn't been turned on yet. The demand from investors just isn't there yet.
So, if all this amazing news from inside the crypto world isn't enough to turn on those taps, then the catalyst, it has to come from somewhere else. And this, my friends, brings us to the absolute core of this whole explainer. The solution is not coming from within crypto.
That's right. The next face-melting, life-changing rally, according to this thesis, it won't be triggered by some new protocol or some killer app. Nope. It's going to be lit by a massive, external macroeconomic force that is already quietly building up pressure.
And there it is, the whole thesis in one sentence. It all comes down to politics. With midterm elections coming up, the government in power has one goal and one goal only: make the economy look as good as possible. And what's the easiest way to do that? You push every button, you pull every lever, and you pump the system full of cash. And when the central banks print money like crazy, that money has to go somewhere. And historically, a huge chunk of it flows directly into risk assets, with Bitcoin sitting right at the top of that list.
Okay, so if you're buying into this macro thesis that a tidal wave of government-printed money is headed our way, the next logical question is, what do you do about it? How do you actually prepare for it? So let's break down a simple, actionable game plan. You really have two main options here. If you're sitting on a pile of cash and you have super high conviction, sure, you could do a lump sum investment. But for most of us, for regular people earning a paycheck, dollar cost averaging, or DCA, is the way to go. You just automatically buy a little bit every week or every month, no matter what the price is. It takes all the emotion out of it and just lets you systematically build your stack over time.
So how much should you actually be allocating? Okay, this might actually shock you. We're not talking about your old 1%, maybe I'll throw some fun money at it allocation anymore.
top financial advisor, Rick Edelman, one of the most respected guys on Wall Street, by the way, is now telling his clients that a modern portfolio should have between 10 and 40% in crypto. That's not some degen on Twitter saying that, that's the establishment.
So the core strategy itself is beautifully simple. Number one, focus on the blue chips. We're talking Bitcoin and Ethereum. Number two, get into the mindset that you never, ever sell your core Bitcoin position. Number three, if you want to play around with altcoins, that's fine, but the entire purpose is to take profits and roll them back into more Bitcoin. And number four, you have to be patient. The alts will have their day, but not until after Bitcoin leads the charge.
All right, so we've covered the problem, we've identified the massive macro catalyst, and we have a game plan. But what's the prize? What's the potential payoff at the end of this rainbow? What could this all be leading to?
Based on this incredible convergence of factors, a completely washed out market, all the institutional plumbing ready to go, and a coming fire hose of liquidity from the government, Scott Melker gives a stunningly specific price target, $185,000 per Bitcoin by the end of 2026.
And really, that leaves us with the final and most important question. The case has been laid out. The thesis is that a tsunami of liquidity is on the horizon. The big institutions built the pipes, and the government is about to crank open the valve. The only question left is, will you be in position to catch that wave when it comes? Hey, if you found this breakdown valuable, if it helped you connect some dots, do us a huge favor. Hit that like button, share this with a friend who's feeling the fatigue, and most importantly, make sure you are subscribed to Crypto Explorer 24/7. Thanks so much for watching.
All right, let's get right into it. There is a huge story developing in crypto right now that is just flying completely under the radar. And while everything might seem kind of quiet on the surface, there's some major evidence that the big players are making some serious moves that could be setting the stage for the next big thing.
So let me just ask you this. What if the biggest, most important moves in the market, the ones that really kick off the next massive run, what if they happen when we're all distracted, when nobody's really paying attention? That's the big question we're going to dig into today.
So while it looked like the markets were just snoozing through the holidays, the big-time players were making some very calculated moves. It really seems like that quiet period was the perfect cover for them to get into position.
And this quote right here, this really gets to the heart of the whole thing. It lays out a theory that's been whispered about for years, the idea that these huge institutions might actually want to create fear and uncertainty in the market. Now, why would they do that? Well, it's simple. The goal is to get regular folks, the retail investors, to panic sell. That lets the big guys swoop in and buy up everything at a huge discount. It's a classic playbook, and we're seeing some serious signs that it's happening right now.
Okay, now let's get into the actual data, because this is where the story gets really, really juicy. We found a massive clue that points directly to this institutional buying spree.
Just think about it for a second. That weird week between Christmas and New Year's. Most of us are just kicking back, taking a break from our screens, not really watching the charts. And that is exactly when the big money decided to make its move. And here it is, $350 million. That is a huge number. While pretty much the rest of the market was on vacation, these institutional whales went on an absolute shopping spree, just gobbling up a massive amount of one specific crypto.
So the key thing to realize is this wasn't just random buying. This was a $350 million highly focused spending spree on Ethereum carried out by institutional whales. And get this, they did it in just 2 days right after Christmas, and they were specifically buying in a price range between $2,700 and $3,000. They clearly like that level a lot.
So this leads us to this really fascinating split happening in the market. You've got two completely different stories playing out at the exact same time. The story of the big institutions and the story of the average investor.
You have to ask, right? If the so-called smart money, these institutional whales, are throwing hundreds of millions of dollars into Ethereum, why is the average person, the retail investor, sitting on the sidelines? Why aren't they following the money?
And this slide just lays it out perfectly. You see the whales over here in full-on aggressive accumulation mode, just quietly buying up millions. And then on the other side, you've got retail investors who are hesitant. They're feeling that fear and uncertainty. There is a massive disconnect between these two groups.
Now, to really understand this disconnect, we got to look at an indicator called the Money Flow Index, or MFI for short. The easiest way to think about it is, it's like a way to measure the enthusiasm behind a price move. It doesn't just look at price, it looks at volume too. It tells us if a price jump is actually backed by real money and real belief.
Now check this out. In the week leading up to Christmas, Ethereum's price was climbing. But at the exact same time, the money flow index was actually going down. This is what we call a divergence, and it's a huge tell. It basically suggests that even though the price was going up, there wasn't a lot of real money or conviction from retail investors pushing it. It was weak. So what exactly are these whales seeing that retail investors might be missing? I mean, they're not just buying on a whim here. They are looking at very specific technical signs on the charts that suggest a huge trend reversal could be just around the corner. So the first signal is a really classic chart pattern called an inverted head and shoulders. Now, I know, it sounds a little weird, but it's just a visual pattern on a chart that very often signals a big shift from a downtrend to an uptrend. So let's just break it down super simple. First, you have a period where the price is falling. Then, the price finds a floor, a bottom. And finally, it starts to show real signs of a new move up. This is the exact pattern that the big players are looking for.
Okay, the second big clue is something known as a bullish divergence. Think of it like a car that's running out of gas while going downhill. The price of an asset might be making a new low, but an indicator like the RSI, which measures momentum, is actually starting to climb. This is a huge sign that the selling pressure is getting exhausted and a reversal might be coming.
And here's the data right here. Between November and December, you can see Ethereum's price actually made a lower low. On the surface, that looks bearish, right? But look at the RSI indicator. It made a higher low. That's a bullish signal. This conflicting data is exactly what a bullish divergence is, and it's a pretty strong sign that the bottom could be in.
So what happens next? Well, according to this technical analysis, the first major test for Ethereum is to break through that resistance around 3350 and then 3390. If it can get past those levels, this pattern suggests we could see a potential run all the way up to $4,400. But of course, this is not financial advice, and there's always a risk. If the price falls below $2,800, then this whole bullish idea is pretty much off the table.
So let's zoom out for a second and look at the big picture here. Because this isn't just about one trade or one chart pattern. This is about a fundamental change to the entire crypto world.
And this says it all, doesn't it? The institutional crypto era is here. It's not coming, it's here. The entire game has changed from those old retail-driven cycles. The big money is now a dominant force in this market.
So what does this mean for the average investor? For you and me? It means the old strategies might not work as well anymore. It is absolutely crucial to understand how these institutions think and operate, and to adapt our own strategies. Because if we don't, we risk getting left behind as they start to really steer the market.
And that really just leaves us with this one final thought to chew on. If the institutions, with all their analysts, all their resources, all their capital, are quietly buying up hundreds of millions of dollars of crypto right now, what are they getting ready for? And more importantly, what does that signal for the rest of us?
That's all we've got for this one. If you found this valuable and it opened your eyes a bit, please do us a favor and hit that like button, share it with someone who needs to see this, and of course subscribe to Crypto Explorer 24/7 for more deep dives into what's really going on behind the scenes. Thanks for watching.
What if I told you that the available supply of one of the world's most well-known cryptocurrencies might be, well, disappearing from exchanges at a pretty alarming rate? Today we're going to dig into the data behind this whole theory of an impending XRP supply shock and, what it could all mean for the market. Let's get right into it.
Okay, so first things first, let's start with the big picture, just to really wrap our heads around the scale we're talking about here. The total absolute maximum supply of XRP is 100 billion. I mean, to put that into perspective, if you tried to count to 100 billion, one number every single second, it would take you over 3,000 years. It's just a truly massive number.
And with a number that big, it's no wonder that a lot of individual investors feel like their personal holdings are just a tiny drop in a massive ocean. Someone in the community really summed it up perfectly. My XRP is a drop in the bucket, just dust. And that's a completely understandable feeling to have.
But what if the whole dynamic of that ocean is changing? Well, some analysts are pointing to on-chain data that suggests a supply shock isn't just some distant possibility. It might already be happening, based on some pretty fascinating market movements we're seeing. So here's the core of the argument, right? They're warning that the amount of XRP that's actually available to buy on exchanges, what we call the exchange balances, is shrinking at a rate we've never really seen before. And that one simple fact could have a huge impact on its price.
Now, what's really wild about this slide is the contrast. So we started with that huge number, 100 billion.
but new data is suggesting there might only be about 1.5 billion XRP left on all exchanges combined. Now that might still sound like a lot, but what it really means is that over 98% of all XRP is already being held off exchange, sitting in private wallets.
And listen, this isn't some slow trickle we're talking about. In just the last few weeks, a staggering 750 million XRP have been moved off of exchanges. That's an absorption rate of over 100 million a week. At this kind of pace, analysts are projecting a full-blown supply shock could hit the market as early as 2026.
So what does this shrinking supply actually mean for the price of XRP? Well, to understand that, we just need a quick lesson on a fundamental economic principle that governs literally every market out there, from houses to crypto: the law of supply and demand.
It's a really simple but powerful idea. When the available supply of something is low and the demand for it is high, the price naturally gets pushed up as buyers have to compete for the limited assets. On the flip side, when supply is high and demand is low, the price tends to fall. It's all about finding that balance.
So this right here is the classic recipe for a price surge. First, the available supply shrinks, which is exactly what we're seeing on exchanges. Then, if demand for that asset stays the same, or even more importantly, increases, the price is almost forced upward. The only real question left is, what's going to happen with demand?
To get a better sense of what might happen next, it actually helps to look at how XRP has behaved in the past. And it turns out when it comes to XRP's market cycles, well, we might have seen this movie before.
As you can see from this timeline, XRP has this history of these long, kind of boring periods of sideways price action. We call that consolidation, followed by these absolutely explosive moves up. We saw it leading into the 2017 breakout, and then we saw the exact same pattern repeat before the 2021 run. And now, here we are, at the end of another multi-year consolidation.
And what's more, each cycle seems to be showing a growing market maturity. That 2017 bull run was kind of like a flash in the pan. The price went parabolic for a few days and then just crashed. But the 2021 rally, it was much more sustained, which suggests that the market is maturing and the demand for XRP is becoming more robust.
Okay, so we've talked about the big picture, but what does all of this mean for the average investor, for you? If you're holding a relatively small amount of XRP, you might be sitting there wondering if any of this market-wide action really even matters to you.
And look, it's true. The day-to-day price movement is largely driven by the big players, the so-called whales, right? The institutions or individuals moving millions of dollars at a time. As an individual investor, it can be super easy to feel like you're just a small fish in a very, very big pond.
But here's the thing you got to remember. You aren't competing with the whales, you're playing an entirely different game. While they might be trading in and out, retail holders are accumulating. And every single time someone buys XRP and moves it to a private wallet, they are personally contributing to that supply shock. Your individual action, combined with thousands and thousands of others, is the very force that's draining the supply from the exchanges.
And hey, on that note, if you want to stay on top of the latest developments in the crypto space and get clear, simple explainers just like this one, do me a favor and take a second to hit that like button, share this with a friend, and definitely make sure you're subscribed to Crypto Explorer 24/7. It really, really helps the channel out. All right, so we've looked at the data, we've examined the history, and we've considered the role of the individual investor. Now let's try to put it all together and see what the future might hold for XRP as we look out towards 2026. Of course, there are absolutely no guarantees in any market, especially not in crypto. But if the supply of XRP on exchanges continues to shrink, and if demand stays strong or even grows, then the basic laws of economics suggest that the price will face upward pressure. It's really just a logical conclusion.
So that leaves us with this final thought to chew on. The available pool of XRP is getting smaller every single day. The next few years are going to be absolutely fascinating to watch. Will this supply shock fully materialize? And if it does, what does that imply for the value of every single token? I guess only time will tell. Thanks for tuning in.